Good afternoon, everyone, and welcome to Altcoin Mentors YouTube channel. My name is Peter, and today we're going to start a new series called Trading Lessons. Very, very simple. So for the first lesson, I'm going to talk about profit taking versus letting profits run. So our main goal here at Altcoin Mentors is to help as many people as possible achieve their goal of financial freedom. We believe trading cryptocurrencies is an opportunity of a lifetime. By the end of this video, you should have a better understanding of what it is to trade like a pro, profit taking versus letting things run. So I'm not asking you to totally buy into what I'm saying. At the end, you'll see why. You should do your own research, dig in and see if this type of system and trading is right for you. If you like our videos, please follow us on Twitter and on Telegram. We also have a model portfolio, so you can view our positions and progress. The link is down below. If you want to be notified of our latest videos, please hit the bell button. All right, so let's begin. So trading lessons, profit taking versus letting things run. So people always ask, how do you trade successfully? Right? When people talk to me, when they find out I've been a trader, everyone gets a little bit excited. Once they find out I've been trading for over 20 years, they get a little bit more excited, because it's hard to meet a lot of professional traders who've been trading for that long of a time. So they ask me, how do you trade successfully? Like, what's the secret? So people, always have some, beliefs, right? And everyone, we hear this phrase, right? Let your profits run and cut your losses. So what do you believe? Do you think this is true or is it false? In my opinion, it's false. And I'll tell you why. So the whole idea is to become a profit taker. Taking profits is the hardest thing for a lot of traders to do, especially when they're beginning. Because what ends up happening is that they get into a trade and there's no preparation work, right? None whatsoever. They go into a trade and you ask them, why did you make this trade? Oh, because it's doing this or doing this. And I say, okay, when are you going to get out? And they say, well, when it hits my stop loss. And I'm like, well, when are you going to get out to the upside? Well, I'm going to just see how it goes and just let it run. Or they say, I want to make as much money as I can, right? And that is not a professional trader. That is a recipe for disaster, in my opinion. So this is what we're going to talk about. So the cons of becoming a profit taker is that you miss big profits. That's really the only con, is that that's the negative, and that's what people are really afraid of. But there are a lot more pros. So the pros for this is that you have more frequent profitable trades. And this is very important. Second one is that you actually have less dollar risk. Too many people overemphasize risk reward, and this is all about making money. And there's less slippage. And I'll talk about that because it's all about math. So let's talk about missing big profits. That's really the scariest thing about being a profit taker. So what I said before was in my previous video is that forget about FOMO, right? Fear of missing out. Because when you do the math about the number of trading days there are, even if you just look at the recent history of trading on Bitcoin, you probably had in the last 2 weeks, 3 really good days to make a lot of money. 2 good days to the upside and 1 good day to the downside, which was yesterday. So those are the days. The other days, they've been languishing. It's been going side to side. So you couldn't have made a lot of money. So imagine if you held on to this stuff, for a long period of time. So you have to get that out of your head, that this trade is a trade that's going to make me into a millionaire. Because most of the time, it's not. What this trade should do is this trade should turn you into a 100-aire or a 1,000-aire. What's wrong with making a few $100 or a couple $1,000 today or this week or this month? So there's no reason to try to get all the money all at once. Because the idea is that the big profits, they don't happen frequent enough. And so if you keep on waiting for them, putting a lot of your eggs in, these baskets where you think that they're going to run, that's where you end up having a lot of problems. So that's the misguided thing. So they say, well, what about Warren Buffett? He holds, he lets things run. So this article from Seeking Alpha, right, contradicts that point, is that Warren Buffett has 100% turnover in about 2 or 3 years. So what does that mean? What that means is that he holds stuff, waits for them to make a lot of money, and then gets out of it, and then turns it over and over and over and over. So that's really what you want to do as well. Even if you're only just trading one thing, just turn it over. You don't have to just keep on holding it, and let it run, because it's going to get tired. And then you can wait back till it goes back down and then buy it back again. And that's really, the key. That's really the difference between being a trader and being an investor or being a position person, So you have to understand and ask yourself, like, what kind of trading, right, do you want to do? So talk about the positives. So the positives are more frequent profitable trades. So this is the chart from Bitcoin yesterday. I talked about this on my 2K 5X challenge. I had a really good day as it was going down. So the whole concept here really is that, did I miss a big trade? No. What I did was I made 5 trades, but I made almost as much money as I would have if I had caught one. And I actually think I made a little bit more money than if I just traded it once, because there were a few times when I actually bought it, right, cheaper, right, than when I sold it at. Basically, it's a little bit different because I was going short. So I sold it, my first trade, I sold it at 90.89. It hit my target of 88.50. And guess what? I sold it again at 89.75. So it saved me $125. And then from 89.75, it went down, hit my target. So that's the key. It hit my target. I got kicked out at certain prices because this is how much money I want to make. So I went in at 89.75. My target was 87.50. It kicked me out. And I got back in again to the short side at 8,800. $50 more right there. And then the next 2 times were very, very choppy because I thought this might be getting a little bit tired. And then I took another trade and I had another, very good runner. So the idea isn't that you're not going to let things run. It's just that you're just going to let things run for a short period of time. You don't have to hold on to it for a very, very long time. So whether you're swing trading or if you're position trading, once you've had a decent amount of money, right? So how many of you bought Bitcoin, right, when it was at 7,000 or at 8,400 over here? And you had an opportunity to sell it at 9,400, 9,600, 9,930, almost 10,000. And as it was going down, what did you do? Right? You had opportunities to sell it at a profit. And then you could buy it back again. So imagine if you bought it at 8,400, a couple weeks ago. Right? As it broke through, 8,400 resistance. Goes all the way up. It goes to 9,900. And you'd have to take profits there. But maybe you take profits at 9,400. You made $1,000. And then it starts going down, 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 down. It goes back to 8,400. And guess what? Now you can buy it back again. Right? But now you have $1,000 in the bank. And that's the key. You don't have to hold things up. So if it goes back up to 9,400, well, good for you, right? You held it and you made $1,000. But if you had sold it up there and bought it back again, now you'd have $2,000. And that's really what I'm talking about. And so the idea is to have more frequent profitable trades, even if they're smaller, because little by little by little equals a lot. So, and there's also less dollar risk. So this is my trading journal that you can see. I have a link to this on the channel. You'll see it there below. You'll see our whole model portfolio and my 2K 5X challenge. So you see that I have a lot of small winners. And where are my big losers? I don't have big losers. My biggest loss was 1.4%. My other loss was 0.5%. The idea is that there were so many times when I could have taken a loss. Like there's one here where I took a 0.05% winner, 0.05%, very, very small winner. But guess what? It's better than having a very, very small loser, right? And so most of the trades where I got out at a very small profit, most of them turned into bigger losers. Not huge losers, but they would have turned into smaller losers. So the idea is just to get out, and then you can always have an opportunity to get back in. Only 2 of those trades out of the many that I made where I took small profits, right, turned into a bigger profit, a runner. So you miss out on those. But if you hold on to them, what about all the other trades that I had smaller profits? And if you add up all the losses that you would have taken instead of taking a smaller trade, it ends up being the same. But what you're doing here is you're putting less dollars at risk. And the last one is less slippage. So slippage is the difference that you pay. The difference is between a stop market and a stop limit. So this is very important. And this is something that a lot of people don't, they always forget about. Because really the key is this your last trade ever? If this is your last trade, you shouldn't care about stop market versus stop limit. But let's say you're a swing trader and you make 1 to 2 trades a week, right? Or maybe you make 1 to 2 trades a month. So you have a heavier position, you trade. If you're trading on one of the crypto exchanges, especially for Bitcoin, you're generally going to take anywhere from 25 cent, 50 cent to $1 slippage for each trade. And that's even when you press, when you have a stop limit. Sometimes it might be hard to get filled, but you can actually get a more accurate price. But imagine if you do stock market. Sometimes on stock market, your slippage might be $2, $3, $4, $5. Sometimes even bigger than that. I've had slippage almost at $15, $20 on a stock market because it just goes so fast. So the idea is that when you take trades that are bigger in size and they're going for a longer period of time and you're trying to get out, everyone's trying to get out around there because they've been holding it for such a long time. And then when they do, right, when the stop hits your order and it goes to market, you're going to be losing a lot, not a lot of your profit, but enough of your profit. So if you do this once or twice a month, imagine how much money, right, you're actually giving just to the market, right, just because you pressed stop market. So do the math and you'll see what I mean. So the conclusion here is that what you want to do as a trader is that you want the greatest returns for the lowest risk. But it's not about percentages. It's about dollars. So what ends up happening is that people have a misguided notion about risk reward. So they go into a trade. Let's say Bitcoin is at 8,000. Right now it's about 8,400. And they say, well, my reward, if it goes back to the upside, right, is going to be 17, 20,000. Right? So that means I'm going to double my money. So my reward is 2. And then what's your loss? Right? You have to at least put it at 50%. Right? So that means that, you're going to put it at, 4,000? So that means that you're going to try to make 8,000 and lose 4,000. Right? That would be like, the ideal situation. But guess what? It's $4,000. Right? It's 4,000 points, whatever, amount you come up to. It's not a little bit, it's a lot. It's gigantic. So what you're doing is you're putting a lot of money at risk. Right? It's not just about percentages. So people see it. So people say, well, what if it goes up to 50,000? Right? What if it goes to 100,000? Right? What if it goes to 500,000? Like some people said. Yeah, maybe it will. Right? But then maybe it won't. So, everything is not linear. It's not just going to go straight up, like to the moon. So in the last few months, you've seen a lot of shakeouts. So when people have been saying things like buy the dip blindly, be a hodler, there are so many people out there who just give the same advice over and over and over again, because that advice is predicated on one thing, that Bitcoin goes to 50,000, 100,000, 200,000. But what if it never goes up there, right? I think I showed you this before about investing versus hodling. Look up Qualcomm, QCOM. Look it up. And you'll see it, that for the last 20 years, almost 20 years, the high was in 2000. And it's been below that high. And what happens if that happens with Bitcoin? It can get close. You can actually make a lot of money in between that range. But if you held it in 1999 and you didn't sell it in 2000, right? Yes, you didn't lose any money, but it's still the same. You have nothing to show for it. You could have sold it and maybe bought it back again, bought something else, done a lot of other things, but you didn't. So what you want to do is you want to be a little bit careful about how much money you put at risk. It's not just about percentages. And that's what people forget. They get lost. So the idea is that this is all about math, right? Do the math. So that's why the whole idea is about a dollar risk adjusted returns. It's not just about percentages. So what ends up happening is that you make 2 trades. Well, let's say, I'll give you a better example. Let's say you make 3 trades. On one trade, you have a winner. You make $1,000, right? I'll take that back. We'll change that up. So you make, on 2 trades, you make $1,000 and $1,000. And then on your losing trade, you lose 1,000. So now you're up 1,000, right? You made $2,000 and you lost 1,000. In my opinion, you're a bad trader, right? The reason why is that you gave up $1,000 on your losing trade. But people say, yeah, but I still made money. right? So basically, I'm still very profitable. I have a good ratio. No, your ratio is 1-for-1, because it's not about making 2,000 and losing 1,000, 2-for-1. It's just that what you have to do is you have to count the number of trades that you made for the dollar amount that you made, right? And then you do the same thing with your losses that you made divided by the number of losing trades that you had, and then that's your ratio. So it's not a 2-to-1 ratio, 2,000 and 1,000, because you made 2 trades to get you to 2,000, right? So your average win is 1,000. Your average loss is 1,000. So you're at 1-to-1, and that is a bad ratio. Because the whole idea is preservation of capital. I mean, like, I'm not a billionaire, so no one has unlimited amount of money, right? So what you want to do is whatever amount of capital that you have in your trading account, you have to protect it fiercely, because it might take you a long time to get that money back, right? What happens if you have a smaller account, 2,000, 3,000, 5,000? So why do you have that small of account? Because that's probably a lot of money for you, right? It's a lot of money for most people. So what ends up happening is that how long will it take if you lose $2,000 out of that 5,000, or if you lose 3,000, or worst case, let's say you lose it all? How long is it going to take you to build that money back up? So what you have to do is you have to just build small, build small, build small, work your way up to it. And then once you become more comfortable, then you can trade bigger sizes in the future. The last thing too is that by having smaller winners, you have a winning attitude, right? Your confidence builds up, and the toll that it takes on you emotionally and psychologically, right, by taking loser after loser or always being in the red, right, is daunting. So what you want to do is you want to take small profits, not just for wealth creation, right? Because what's going to do is it's going to be a bell curve. You're going to make small amounts of money, for a long period of time. And then eventually, as your account grows, it's going to turn into a lot. And if you do the math on it, right, you'll really see it. And the last thing is that you're going to have fewer equity swings, because you're not going to see, your account go to the moon, but you're also not going to see your account go down. That's the key. Like, how many people have bought Bitcoin when it was at like 5,000, 6,000? I know a bunch of people who did that. And they got in a little late. They bought Bitcoin around 5,000, 6,000. They didn't sell it at 17,000. They didn't sell it at 14,000, 13,000, 10,000. They're still holding on to it. So good for them, right? They made $2,000. But at any given time, they could have sold it and made more money and then bought it back later, right? So if you bought it at 6,000, guess what? You had 2 opportunities to buy it for around $6,000, in the last couple months. So you could have bought it at 6,000 in November, right? See it go up to 12,000, 13,000, 14,000, sell it, maybe buy it back at 10,000. It's cheaper than what you sold it at. So you can keep on doing those things, and you can actually make more money. So there's no elevator to success. You have to take the stairs. So remember one thing. These are my opinions alone, and this is my trading style. It doesn't fit everyone's psychological profile, emotional profile. Maybe you only have, a little bit of money, and you don't mind losing it all, right? And you want to just shoot for the moon. Great. That's all up to you. But if you believe, or if you doubt what I'm saying, right, do the work. Get out your Google Sheets or Excel, put in all of your trades, go through all of your, research, and look at the number of trades you made, and you ask yourself, man, what if I could have turned this small loser into a small winner? How many times did I have an opportunity to get out with a small profit? And if I had done that, where would my equity account be, right? How much money would I have in my account now? If you do that, if you do the math, I think you'll come to the conclusion that becoming a profit taker, right, is a better way to go. So we thank you very much for watching. We do this so that people can achieve their goal of financial freedom. And it's our pleasure to try to help as many people as possible not become followers, because that's not what we're looking for. We're not looking for followers. What we're looking for are people who want to learn, right? People who want to get better. Because our trading style, the things that we do, might not be for everybody. But maybe you'll take one thing from what we said and maybe use it in your trading strategies and make a little bit more money off of it. If you can do that, then we've done our job. So if you like our videos, please share it with your friends and other crypto traders. You can also follow us on Twitter and on Telegram. If you have any questions, please ask away in the comment section below. We do a very good job of answering all of our comments and questions right away. Thank you again for watching, and see you in our next video.